Insurance stocks over time have proven to be really good investments. Just ask Warren Buffett, who's made a lot of money owning Geico. Now, it's always important to buy stocks, whatever sector you're investing in, at the right time. Buying when prices are low and you're anticipating that stock prices are going to go up. And that's what I hope to reveal in this video is scorecarding, valuing the top insurance stocks that are available in the United States. I'm going to scorecard based on metrics that are most important to insurance. For instance, the combined ratio is really important. The return on equity, price to book, and of course, the PE ratio. Seeing based on those ratios, which is the best company that's performing based on that metric, and overall, which one is going to be the best discounted stock to consider investing in. As always, I'm sharing my research on stocks and specifically in this industry. This is not financial advice. It's always your decision on which stocks you're going to own. But I'm sharing with you my logic and my process as I invest in stocks. Let's get started. Progressive has the highest market cap for insurance companies. It has $85 billion of revenue, a forward P ratio of 13.7. They pay a dividend of 2.17. This stock, according to analysts, is discounted by 23%. Over the last 5 years, this stock has really worked, especially from 2022 on to 2025. But it's recently really pulled back, especially after their earnings. What's going on? Is this stock really beginning to decline? And is it going to cost investors? It may be the case. Year to date, it's down 5.8%. This company had been flourishing, growing its top line revenue, which is very good. Let me look at some metrics for Progressive, starting with the PE ratio. Again, is for the forward P is 13. The price to book 3.73, and that's one of the highest ones that you could find for insurance companies. So the price to book, it's showing that the stock price is expensive compared to the overall book value. In addition to that, the return on equity is 34%. That's really high. That's a positive. So the return on equity is excellent. The price to book is bad. So that's where we're at with those ratios. Looking at a forecast of what analysts are thinking about this stock, some analysts are very high on the stock. This is one of the more popular stocks within insurance. Progressive is the leader. It's been attracting a lot of investors for years. And collectively, the consensus is that it's discounted by 23%. 14 analysts are covering this stock. And looking at the growth in revenues, they're going to continue to grow. Earnings per share is going to take a hit next year. I think the stock has really sold off. And as I'll show a little bit, the combined ratio really went to the negative. This combined ratio went above 100%. And what the combined ratio means is that they're spending more in claims and other expenses than the money they're bringing in. So they're operating at a loss. That's why the stock has been selling off. And you can see that in the expected earnings per share for 2026. So looking at the next quarter or two, this stock may be under pressure. Fundamentally, there's a reason for it. They're not making money, and that's a problem. I took the fundamentals for Progressive and entered all that information into my valuation model, taking free cash flow data, creating a forecast for that free cash flow, also looking at earnings per share data and creating a forecast for earnings per share. And I get a 24% discount available on Progressive. It's not a very high discount. And in fact, when you look at earnings per share, it's actually priced at a premium. Now, this stock here has really been under pressure. And I'm not sure that pressure is going to go away until they put up a quarter or two of positive, constructive improvements on that combined ratio. This stock's probably going to rank toward the bottom of my ranking, but let's continue on and see how the other companies look. Allstate is the next company. This is a $51 billion market cap company with revenues above that market cap at $66 billion. The PE ratio is really low, 7.75 for 2026. It pays a dividend of 2%. and analysts do believe it's discounted by 16%. This stock has worked for the last 5 years, and it hasn't seen a big drop like you've seen in Progressive, and also Chubb, which you'll see later, had a big drop. So this stock here is doing well for the 5 year. The 1 year isn't all that great. It's pretty much flat. And year to date, it's up about 1%. So it's not keeping up with the S&P. This business is growing top line, so that looks good. And when we look at other ratios that are important for the insurance business, the combined ratio for Allstate is 91%, below that 100%, meaning that they're making money. If you're below 100% combined ratio, it means you're making money. Now, it could be better, but it is positive that they're making money. Other statistics that are important are looking okay. PE ratio looks great. The price to book, 2.35, is not the best we're going to see, but it's in the middle of the road. And last, the return on equity is 27%. Not the best we're going to see, but it's very good. 27% return on equity is very good. So the specific metrics I'm looking at for insurance for Allstate look good. The forecast, some analysts are quite high on the stock, saying this stock can go up to $285 per share. On average, the consensus is the stock is discounted by 16%. Now, they're going to announce earnings this coming week, so it'll be interesting to see how they come in. But it's expected that next year, they're going to continue to grow at 7%. Looks good. I've taken the fundamentals for Allstate and completed a valuation based on free cash flows and earnings per share. And when I look at the net present value of this company, it has a 53% discount if you compare the value of each share compared to the current stock price. That's a really nice looking discount. The free cash flows look great. And this is a well-operated insurance company that is generating a lot of cash. The earnings per share with that really low PE also offers a discount. I'm more optimistic than the analysts. The analysts were at a little over 16%. I'm at 28% when it comes to earnings per share. So a 53% discount with a business that has a good combined ratio, an excellent return on equity. The metrics look really good for Allstate. They haven't had a big sell-off like Progressive. This is looking like a very good stock. Chubb is the next company. It's a $106 billion market cap company with revenues of $57 billion. The forward PE looks rather attractive at 10.5. Its dividend is a little low at 1.45%. And analysts do believe there's a discount available of 14%. This stock's done well over the 5 year. It's up 125%. The 1 year doesn't look all that great. It's down 8%. And the year to date, it's down 3%. Now, Chubb has had a few surprises, negative surprises, which have caused these sell-offs. Looking at revenue growth, the revenue growth does look good for Chubb. That looks really, really good. Looking at other metrics that are specific to Chubb and insurance, their combined ratio looks really good, better than the other two we've seen to this point. 85.6 means that they're making money. They are paying less expenses compared to the revenue they're bringing in on these insurance policies. The other metrics, the PE ratio look good. Price to book 1.5 looks really good, lower than both Allstate and lower than Progressive. When I look at the return on equity, 13.6% is low. It's lower than the stocks we've seen so far, and that's rather low to put it out there. So the metrics, some look good, one looks bad. Analysts, 17 of them are covering Chubb, and they consensus believe it's 14% discounted. As they put together their forecast, the company is supposed to grow in 26 and 27, and the revenues are really going to expand in 2026. Looking like this might be a nice little opportunity if they really come through and provide really good earnings reports. I think this stock might see some nice days of appreciation. Chubb is 49% discounted. When I compare the value of the stock based on future free cash flows and also the value based on earnings per share that I expect, that's a really nice discount on a stock that seems to be setting up to have a really good 2026. Old Republic is a smaller cap at $10 billion. with revenues of $8.67 billion. P ratio is at 12.5 for 2026, and it pays a nice dividend of 2.8%. Analysts do think it's discounted by 13%. The stock's done really well for the 5-year, up 161%, which is the best appreciation I've seen so far. And the 1-year looks good, and the year to date looks really good. So this has been really consistently appreciating in price and returning really nice returns for investors. This company is growing nicely at 14%, and we'll take a look at their forecast in a bit. Looking at their specifics on statistics, the price to book ratio is 1.6, which is really good, comparable to Chubb, lower than Allstate and Progressive. You want to have the lowest price to book ratio you can possibly have, showing that the value of your company is aligned with the stock price. Looking at return on equity, 14.6, not as high as Progressive nor Allstate, 14.6, which is good, but not great. The combined ratio for Old Republic isn't great. It's 93.6. It's below 100, which is good, but not as good as Chubb nor Allstate. So that is one of the lower ranking metrics for Old Republic. Not a lot of analysts cover Old Republic because it's a smaller cap, but the forecast is available, and it's expected that this company is going to continue to grow in 2026 and 2027. The profits are going to expand in 26, but then go down a little bit in 27, with P ratio hovering around 12. When I value Old Republic, I get a 27% discount. That's when I combine the value of their free cash flows and the value of their future earnings per share. Now, 27% is a good discount, but not a great discount. I'm showing you a variety of insurance stocks, and some of them are going to have some really nice discounts available. Palomar Holdings is a small cap with just $3 billion in market cap. Its revenue is $682 million. Forward P is 14.6, and analysts do think it's discounted by 29%. Over the 5-year, this stock hasn't kept up with the other insurance companies that have gone up in appreciation more than 100%. But over the 1-year, it is getting the job done with 16.86% rate of return. So overall, this is an interesting stock that it's had more volatility and not a consistent upward trend. This is a smaller business, really growing fast, 53% growth. That looks really good. Looking at their statistics, their price to book is 3.6. These smaller businesses are going to have trouble with the price to book. And this one is a high price to book, meaning you're paying more for the business. It's more expensive. You want this to be as low as possible. If it's below 1, that means the book value is actually more value than the actual stock price. In this case here, we're at 3.6. So that's very high, showing that it is very expensive. Return on equity of 22.4 is fairly decent. When we look at the forecast of this business, we've got 7 analysts covering them, saying this is really discounted. They expect that the business is going to continue to grow in 2026 by 18%, which would be impressive. And overall, their earnings per share will expand, bringing down their PE ratio. So the growth does look really interesting for this small cap. Ratio for Palomar is really impressive, 78.8%. That's the lowest that I've seen so far, showing that this particular insurance company is making money. That means that their expenses are roughly 78.8% of what they're bringing in the form of revenue. When I value Palomar stock, I get a 50% discount. I believe each share is worth $230 when I weigh the value of their cash flows as well as the value of their earnings per share. But the stock is trading at 114. So this has very good upside. It's riskier, but it has very good upside. Fairfax Financial is located in Toronto, Canada. It provides insurance to Canadian folks as well as U.S. consumers. $42 billion market cap with $37 billion of revenue. Forward P is 11. In this stock, the business has been growing nicely, 13.48%. Very nice growth and very consistent growth over the last couple of years. The stock has been appreciating well for the 1 year. Over the 5-year, it's really done great. a tremendous appreciation for investors. Looking at these statistics, the PE ratio is nice and low, 11% for the forward. Price to book 1.4. That's the lowest price to book we've seen so far. That's showing that this business is really well priced compared to its book value. The return on equity 17.3. It's not bad and it's not good. It's right in the middle. 17.3 is decent. The combined ratio for Fairfax is 93.3, which is acceptable. It's below 100, but it's not the best ranking one. It's far from it, but it's decent. Fairfax offers a 50% discount. When I calculate the value of the stock based on its free cash flows in the future, as well as the earnings per share it's expected to produce, it is discounted by 50%. It's an attractive discount on a stock that's really been performing well. Fairfax over the last 5 years has performed the best out of the stocks that we're looking at in this video. The final stock I'm going to look at is Root. And this is an exciting new business doing it a different way versus the traditional insurance company in attracting customers to have a policy with their company. It's a $1.17 billion market cap company with revenues of $1.36 billion. The PE, the forward PE is really low at 69. That's concerning. Analysts do think there's a big discount. Now, this stock's been places. It's up 76%, but you could see that it really rose and it's really come down more recently. Over the year to date, it's only up 4%. Over the 1 month, it's down drastically. And the 5-year, you could see that when it IPO'd, it really sold off after its IPO date. So this one here is smaller with a lot more risk. It's a smaller business growing really fast. And I do like their acquisition model for new customers. Looking at their statistics, the price to book is 4.76. That's the highest ratio we're going to see. And that shows that this is the most expensive company based on its book value and what you have to pay in the form of that stock price. So this one is ranking the worst out of the bunch. Return on equity of 27.5 is quite good. It's near the top. Looking at the forecast, we've got 5 analysts commenting on this stock, and they think it's drastically discounted. It's expected that they're going to grow, but not as at the high rates that we've seen recently, which is a little bit of a concern because it's being priced as a growth stock, but it's stopped growing really fast, which is probably why the stock's really sold off. The combined ratio for Root is 95.2, which is below 100, meaning they're making money. They're getting more revenues than the expenses they have to pay to honor those policies. But that's not the top of the stack. I think they're probably near the bottom of the stack with just 1 or 2 businesses that have a worse ratio, while several others have a much better ratio when you look at the combined ratio for insurance. Root is one of the most risky stocks that I'm going to look at, but it also provides potentially the highest discount potential of 74%. That's when I compare the value based on its free cash flows and its earnings per share and compare it to the current stock price. So this is higher risk with potential higher reward. So I've reviewed all the insurance stocks that I listed. Now it's time to rank them from best to worst. Let's take a look. In the number 1 spot is Allstate. Allstate has the best PE ratio, and its other ratios are right in the competitive area of insurance. Its combined ratio is below 100. Its return on equity is 27. Price to book is kind of middle of the road. Palomar is number 2. It has the best combined ratio, has really good return on equity. Its price to book is a little high, and its PE ratio is a little high. The third best stock to invest in within insurance, in my opinion, is Fairfax. It has the best price to book ratio. Its return on equity is not as good as Allstate, and its combined ratio, again, not as good as Allstate nor Palomar. Its PE ratio is not as good as Allstate, but it's a pretty decent investment if you're very comfortable investing in a company out of Canada. Old Republic is in 4th place. It didn't lead in any category, but it has some pretty decent metrics. For example, price to book is rather low compared to others, and everything else is acceptable. Progressive in fifth place. It has the worst combined ratio, meaning that it's basically paying 100% of its revenue in expenses. The stock's been selling off for that reason, showing that the stock's not making any money. It's actually losing money once you combine the general operating expenses of the business. In sixth place is Chubb. It has the lowest return on equity. It has a good price to book in a combined ratio and a PE ratio. And number 7 is actually a stock that I own, and I've decided that I'm going to be selling this stock, and that's Root. The price to book is the most expensive. The P ratio is out of this world. Those two really are red flags for me, and I'll be selling Root. Root is the worst stock on this list that I could invest in. So that's my review of insurance stocks, looking at the specific metrics that are important for insurance companies and seeing where there's opportunity, where there's risk, and where I should be putting my capital. Thank you for watching the video. I hope you found it interesting. Would you like more access to content like this? Consider being a paid member. You get more real-time access to videos when they're published. You also get access to a Discord and many other value-add benefits for investors, like access to the tools that I use when I analyze stocks. Take a look at the 4 levels that are available on the homepage of my YouTube channel. Thank you.